There we go.
I
We are
think we are
live.
all set and up and running. I see about 16 people on the call. Uh, Everyone can hear me, no issues. I think we're good. Okay.
Good.
Well,
Awesome.
it is just a few minutes after, so I can get started, or we could wait a couple minutes to see if some others join.
Do you want to give it a minute, Rick?
Yeah. I see some external people joining, so
Awesome. Cannot believe it's May. I woke up this morning like it's May today, halfway through the year nearly. I'm like, how did that happen?
yes.
How? The days are long, the years are short.
Yes.
That's my thing.
And as we get older, it goes faster and faster.
Like a train, an Excel train,
Yes.
just going. All right,
Hey,
Rick. I think
yeah,
we are good to go.
we're gonna go ahead and dive in. I have been given some questions up front that I can go through. I really want this to be interactive, um, make it very casual. That way we can walk away with learning something new. Um, I'm going to start off just with some of the questions that came through as far as um, just some ideas and topics to discuss. I loved what came through. One of them is a topic I like to talk about a lot, and that is what is the biggest hurdle that I come across that kills a buyer's loan? That is such a good question because there are so many variables um, in each file. I hope I am able to sum this up in what I feel is the biggest hurdle. And one of those is income. And when I talk about income or why I see that as a hurdle, is I think it's more of a hurdle in our world, in my world, in underwriting. And why I say that is because with COVID happening, the economy changed and the way people are working is different. Yes, we still have our traditional, salary, full-time, 40-hour work week type of borrowers, but there is this huge trend to hustle is kind of the term you hear nowadays. Is like I'm hustling, I've got side jobs, I've got this job, and that's really becoming more and more predominant in our economy. And what that looks like is, people in their 20s and their 30s, COVID happened, maybe they're just getting established in their adult world, adult life. And then that happens and they had to adjust and they had to figure out how to generate income. And I think a lot of people learned through COVID that you can generate income through multiple sources. Why does that become a hurdle? Is because it is important for anyone who is sitting and looking at that borrower and their income to not just be focused on the paper itself, but understanding the industry, understanding the borrower themselves, and taking the time to not get caught in what happens in my world in underwriting, which is very black and white decisions. I like to play in the gray. Underwriting is about playing in the gray because things are not black and white. But I'll give you a good example of where a hurdle happens, and a lot of lenders do this, which I actually don't understand why. But if a borrower changes a job, let's say I change jobs, there are a lot of lenders out there that would require me to be on my new job for 6 months before they'd ever give me a loan. Well, I've been in the mortgage industry for 33 years. I've been in my current role for 14. If I was switching jobs, why would there be a concern about my stability when in fact that's all I've ever done? Yes, there's the what if you get to the job and then 90 days you're in probation and you end up losing your job. We would never loan money to people if we thought with those thoughts. So it's important to look at the borrower's history and understand, yeah, their job is changing, but the name on the building is changing, not the actual job itself. That is a hurdle I find quite often. I know here at DML, We pick up a lot of loans where borrowers have changed jobs, and that is the constant is they want them on that new job for 6 months. Where that could be a hurdle if the borrower isn't a salaried type of borrower. And when I use the word salary, I mean guaranteed X per week, X biweekly, X every other week, a semi-monthly. Borrowers who work 40 hours a week, I think of as salaried as well. A lot of people don't know this about the underwriting world. Most underwriters are paid hourly. Therefore, they are still paid a salary, but the way the calculation happens is through a calculation of 40 hours a week. Um, if a borrower is working hourly, and this is where this change in the economy is creating this hurdle, is when they are not working those type of jobs. And what do I mean by that is a lot of borrowers work variable hours, and underwriters will get caught up in that thought process and think, okay, well, one week they earned 25, they worked 25 hours, next it was 30, then it was 28, and then it was 42. They start seeing that as variable income, and variable income can be very challenging for one reason only. There is a minimum required amount of time that you average that, and it's typically over 12 to 24 months. So if you've had a borrower who works hourly and they have increases during that time, that average really can hurt you because it's not taking that into consideration. Something we do at DML to avoid that variable income calculation is looking to see if there's a consistent set of base hours. I understand that a borrower may work 26 hours and then 28 and then 32 and then down to 25. But if they're always hitting 25 hours, I don't see them as variable. I will use that as my baseline calculation. I could spend a lot of time talking about income because it is the one topic I spend most of my day analyzing. So I'm going to put a pin right there in that piece of the conversation and open it up to see if anyone has any questions. Is there anything that I can clarify in that? I'm sure you're seeing a lot of variable income type of borrowers that may not really be falling within that category.
Everybody, you should have permission to unmute yourselves if you want to ask questions verbally, or you're welcome to use the chat to chime in on the conversation too.
I know Carla had a good question, and this is related to how does an underwriter view a 9-month employment gap post-graduation from college? That is a great question. It depends on the program, and it depends on what job they're going to get. Because if they're not going into a salary type of job, and I think of people who have shift differential, I think of people who have per diems, things like that. The gap could be a challenge because it's hard to establish what those earnings are without a history. In general, a 9-month gap from a conventional loan from school to a start of a job would not be an issue. We can consider schooling as part of the prior history before the gap. Conventionally, a lot more liberty in how we can look at that. Generally, gaps for conventional are not an issue. FHA, it will always be an issue because if you have a gap in employment, FHA requires you to be on the current job for 6 months prior to ordering the case number. So a lot of people miss that. The other piece that people miss on that gap with FHA is you have to have an uninterrupted 2-year history prior to the gap. So what does that mean? Is they have been consistently employed for 2 years prior to the gap. What I find happen, and this can be a hurdle on an FHA loan, is they had 6 months, then they had a 2-month gap, and then all of a sudden they had the remaining portion of that gap or that employment history filled. If there's not continuity 2 years prior to that gap, it's going to be, unfortunately, a decline for that reason. We wouldn't decline the loan. We may have to just hold it until we meet that seasoning. Carla, does that answer that question? I hope so.
Yes. So,
Oh, FHA nurse. Yes.
uh-huh.
Ooh, that's a tough one. Nurses are fun because there is so much going on in their income these days. FHA, a 6 month gap would be an issue, and we cannot overcome that with, well, she was studying for her state license, and we know that takes time. That comes up with like lawyers and doctors and whatnot.
That does answer my question. Thank
Yeah.
you.
So that
I
six
have a
month
good
gap is
one.
going to apply there.
What about people that have gone from hourly working for a hospital and they went to working I guess it would be on-call contract type job? I know we're really good at that. That's why I'm putting you on the spot.
I love that question because nurses are fun. Question on that, are we talking about like going on contract, like traveling nurse type of thing? That's where my brain
Yes,
goes with that question. Okay.
traveling nurse. Yep.
Yep, there are no guidelines around this type of borrower. Where it falls in the category of analyzing is contract type of employment. I approach nurses a couple of ways. My easy approach is if I have a nurse who went from staff to contract, if they've been on the contract job for a year, I don't spend a lot of time analyzing. I'm going to analyze the most recent year. I'm going to know, I'm of course going to look at the increase from the prior year to the most recent year, to see how significant that is. But with a year history as a traveling nurse, it's easy to make, or a contract nurse, because they're, don't want to just bucket traveling nurses into that. Um, the year gives us enough stability on that job to make a case to use that income. When you get less than a year, it becomes the gray area. I will tell you, we typically don't do it if it's less than 6 months. Because 6 months with contract nurses typically means you've had two 90-day contracts. So we've got 6 months worth of earnings there. The challenge with that is going to be, how do we calculate the income? That could be a combination of averaging prior years with the most recent. And I know most people's brains going, but they're not making that money anymore. Well, it's a way to avoid saying, I can't do the loan, because most lenders will be like, 6 months traveling nurse, we're not doing the loan. For us, we step back and go, well, you're a nurse. You've always been a nurse. You've been doing it for 10 years. We know at the end of the day that if you get tired doing the contract thing, you can go back and be a staff nurse. Healthcare is understaffed right now, so a lot of job openings, so it's easy to find one. Um, we would look at it from that standpoint of averaging prior and current. If you have a contract nurse or contract employee less than 6 months, I've closed loans where I've used their income from their prior job. I know that people's brains go, but they're not making that anymore. I look at income in segments. Source, meaning, was it all nursing? Great. Then I look at my calculations. What do my numbers look like? And then I go to my third step, which is stability. And I always think of stability in the simplest way. If my borrower lost this job, could they replace that income, and how quickly and how easily? And a nurse, if I'm using, let's say, their staffing wages prior to becoming a contract, and they made, let's say, 85,000, I qualify at 85, but now they're making 150,000, but they've only been doing it for 90 days or maybe 5 months. If I can get away with the 85, I'm going to use it. All that year to date is doing is supporting the fact that my borrower is still making that money. What I know in that scenario is that if the contract doesn't work out, that person's going to go back and make $85,000. So it's an easy number to put a baseline on. It's really that, between the 1 and the 12-month period with contract borrowers, specifically nurses, where you've got to dive in and see. My main focus on this is always the stability. And again, the stability in my mind is if the person lost their job today, within the next 10 to 15 days, could they replace that income? Because my responsibility is to make sure that we don't default, the borrower doesn't default. And the one way to do that is to make sure you're solid on the stability and the source of the income. Does that help, Michelle?
Yes,
You're on
it's
mute.
perfect.
This is where I find our group of underwriters really step outside of what most are used to in the industry. It's I really coach and lead from the standpoint that it's our job to understand how to calculate income and do the numbers, but it is also our job to have a much bigger understanding of the industry in which that person works. I'm going to use a really great example. Like most people would not know this. I only know this because I'm a Pacific Northwest guy, so Boeing is a big part of my underwriting world and the history. Most people would not know, and I had a scenario come up recently where they were working at Boeing, or they had worked at Boeing, left, went to another airline manufacturer, came back, been back on the job, but the overtime had dramatically decreased since they came back to Boeing. Well, when you look at the history of it, the borrower has a history of overtime, but what most people would not know is if Boeing stock is down, they don't pay overtime. They don't pay it. It's a understanding here in the Pacific Northwest that Boeing's employment is driven all by what their stock price is doing. And recently, if you haven't seen the news, Boeing has been having issues with planes. Therefore, they're getting impacted by that in the market. And so when looking at this loan, when you look at the surface of it and you do the calculations, excuse me, it looks beautiful. Now, could you make the argument that you were stable? I guess you could, based on the fact that Boeing's a stable company, but knowing the economy and the impact things have on specific industries has to be taken into consideration. That's kind of a negative as I'm saying that and hearing me say it, but then I go back to the nursing situation or the contract. We don't get, we look at that from a much bigger picture than most, because some would say, well, if you're not working at this hospital anymore, I don't know that your income's stable unless you're on the job for 6 months. You're a nurse. Like you're a nurse. So there's a lot of variables in looking at income these days, and I pride myself and my team and the underwriting team here at DML on taking the time to understand beyond the paper that's just sitting on the screen and the numbers that are staring at you.
Love that. Rick, there are a couple questions in the chat, one from Cynthia and one from Jeannie.
All right.
How do underwriters view employee gaps in general? Especially if somebody's self-employed, sells a business, takes time off. Good question.
That is a great question. The gap is going to be driven by the months. If we're talking about a conventional loan where we don't have to worry about gaps, a borrower selling their business and taking time off work to enjoy life and having an established job to return to, I'm not going to penalize them for that. What they've done is they've reduced my risk. They're no longer self-employed. Self-employed borrowers tend to fall into a much higher risk bucket than a W-2 borrower. So if they were working a job or had a business, sold it, more than likely they're going to end up getting recruited into some kind of role that would be similar to the business they owned. We could look at that from an offer letter standpoint. From a conventional loan, they could be on their job for a couple weeks. Again, where I think, or where my brain's going there, is thinking of stability, right? Now, someone could say, well, you can't really compare their current wages to their wages when they were self-employed. Well, yeah, you can, because this goes back to my 3 buckets. What's the source of the income? Just because you're self-employed If you're a mechanic and now you're working as a mechanic for a business getting W-2, your source of income is from being a mechanic. So it's important to look at that as well. On conventional loans, I want to make sure I'm clear on the gaps. The conventional loans is the area we don't have to be too concerned. FHA, it is cut and dry, the 6 months. If there's a 6-month gap between one job and the next, regardless of the situation, could be mom took time off to have a baby, could be health related. Unfortunately, that is something FHA changed. For years, they had a return to work policy where you didn't really have to validate any employment. So a parent could take time off work because they had kids, stayed home for 10 years, went back to work, been on the job for 2 months or even 3 weeks, and FHA didn't care. They've made it very clear now they want the borrower on the job for 6 months prior to being able to issue a case number. Did that help, Cynthia? Like Tom has one. Jennifer has one. I had a condo sale where the HOA complex insurance had a high water damage deductible of 25K. We found certain lenders could get borrowers to qualify, but others could not. Is this indeed lender specific? Great question. No, it is not. The agencies do not have specific guidance around deductibles. Do they have for liability and building coverage and common areas? Yes, but there isn't anything in the guidelines from an agency standpoint that says your deductible needs to be less than X. What we're responsible for doing is making sure that when we're analyzing the business or the association's budget, if we are required to, that there's adequate coverage to pay for that deductible. For example, if you're not familiar with condos or don't do a lot of them, there's got to be a 10% allocation to reserves. We look for that along with if it's a $25,000 deductible, do they have the wherewithal to do that? There's a couple ways to analyze that. Do they have the funds sitting in a bank account versus collecting? Because some associations get to the point where they've got a few $100,000 sitting in reserves. We know repairs have to be made at some point, but those reserves can cover those the larger deductibles. So if I was to sum that up for you, Jeannie, it would be that is lender specific.
Thank you so much. One other thing though,
Yeah.
there was something about a Fannie Mae guideline that those reserves have to be, or I'm sorry, the deductible has to be a certain percentage of the reserves. Do you know anything about that? That's just something one lender told us and we went to another lender.
I've never heard of a percentage of my reserves being my deductible.
I think what you just said about it, having that HOA having enough funds to cover, that's what I think they mean. It had something to do with the Florida condo collapse. And so now HOAs are, and I'm seeing this a lot in Arizona,
Yes.
and HOAs are being very restrictive with information. So it's really hard when you get a listing to get any of this information on reserves, unless you're the property owner and you have a portal and you can log in. But unfortunately, a lot of my clients are seniors, so it's a little bit difficult. But thank you.
It makes it, yes. We can help in that. We have access to things. So if you're ever running into a challenge there, definitely talk with the loan officer you're working with and we'll help navigate that. You brought up a good point. The collapse of that building in Florida has caused shock waves in the condo world. Agencies have adjusted to it. So if lenders, I want to talk about that real quick because we are responsible for reviewing and making sure that there isn't any potential issues out there. But that if we have documentation in the file and what we obtain based on condo questionnaires and things like that, we are seeing those hurdles as far as getting the information goes, getting the information to be able to make the decision. It just takes a little bit more time. I knock on wood, I don't think in the change have we had any issues with getting our condos closed related to inspections, homeowner minute, HOA meeting minutes. But there definitely is an impact in the market from that. I don't know who works in Florida, but that has become a really big challenge from an insurance standpoint, not only in condos, it is now houses. Insurance companies are no longer insuring there. Deductibles are really high, premiums are becoming really high. And that makes it difficult when you're dealing with especially a first-time buyer who's FHA, where you're really pushing those DTIs. Uh, Thomas has a question. What would be a decision if both spouses are independent contractors and they get declined for a loan? Independent contractors, I tend to think of 1099. We're seeing a lot of that. I think of 1099 borrowers kind of like W-2 borrowers. They just don't have their taxes taken out and they have to take care of that at the end of the year. So there's a lot of area that we can analyze based on that thought. Two borrowers being independent contractors, there's a lot of areas that fall into the IT people. Some cases, I think real estate agents fall into that independent contract area. As long as there is an established history and there is no concern with the history and the income stability, I would not ever see declining a loan just simply because two borrowers are independent contractors. I kind of think of the same thing like self-employed borrowers. If I had two self-employed borrowers, I wouldn't decline simply because they're both self-employed. Now, if both borrowers' incomes were declining, or something like that, that would be a reason for a decline possibly, but not just simply off of being two independent contractors. Does that help, Thomas? Are you having any issues in Ocean City, Maryland with condos? Reserves are not where they need to be. Some associations are refusing to get their reserves in line per the reserve study. Ooh, that is a interesting question because there's a couple things going on there. I find the smaller projects tend to have the reserve issues. Because if you're 22 units, 10% of the budget going to reserves could be quite hefty for those two, for that 22 unit project. So the smaller projects, yes. One of two things must happen. Well, one thing must happen or it results in another. The one thing that would happen is the budget has to be corrected to allocate for that because it is a firm 10% of the budget. While I'm there, I want to clarify something or share something that people may not know. If your project includes where the association dues cover the water, sewer, water, garbage, or they cover cable. Older buildings sometimes have cable included, or heat. Older buildings, sometimes it's a collective heating of the entire building. I lived in one of those projects, type of projects. Those all get to be added back in. So if your budget, let's just use simple numbers, 100,000 and 5,000 of that is being collected for sewer, water, garbage. 5,000 of that's being collected for cable and 5,000 of it's being collected for electricity. Let's just use those three. My budget is 100,000 a year, but 15,000 of that is actually what people would normally pay independently. And because of that, I can take that $100,000 budget and reduce it by that 15,000. And I only need reserves for the 85 versus the 100. So there's a lot of people out there that don't know that they can add those things back. And the simplest way to think about it is if I'm paying HOA dues for electricity, I normally would just pay that independently. So that does not need to be something that reserves need to be collected for. As far as the reserve studies go, I'm starting to see some reserve studies where they come in with a hefty allocation needed to get caught up. In my review of the guidelines, there is nothing that tells me that I have to rely on the reserve study to determine what the required reserves are on an annual basis for my project. I'm not required to do that. I'm just required to make sure there's 10% being allocated. So I know some lenders out there are really struggling with the fact that they're either not getting a reserve study, or the reserve study that's provided doesn't look great. Reserve studies are interesting in my opinion from the standpoint of you're allocating for things that happen in the future, and usually it's a projection of 25 to 30 years. Why do people not want to pay the reserves or have association dues change based on reserve studies? Because I'm only going to own it for 5. So do I really care in 10 years if the roof is replaced? I don't. And that's what happens in associations. They look at that and don't want to do that, kicking the can down the road. For us internally and how we're reviewing those, if a reserve study is not provided, we can't mandate that there is one. We are going to look at the questionnaire that is provided. We're going to look at the association minutes and see if there's anything that's popping up. What we're looking for in those reserve studies and those HOA minutes are situations. I have a friend this just happened to a couple years ago, bought into a condo project. Nothing in the documents that she reviewed showed that there was going to be a special assessment. She closed, and in 60 days later, she had a $147,000 assessment. She didn't know about it. Granted, she went and taken care of that legally. But if she would have read the HOA minutes, it had been discussed for almost a year. The questionnaire did not have that information on there, nor was there a reserve study. So on the surface of what we would normally look at, we wouldn't have questioned anything. But because now we're looking at those HOA minutes, that would have popped up, and then we would have had to address that. Not from a reserve study standpoint, not from a reserve standpoint, but really what's going to happen is it going to be result in a special assessment where we have a monthly obligation that we have to take care of and include in our DTI. A lot of times what happens is the HOA goes out and they get the financing, and then HOA dues are just adjusted accordingly, or there's a small assessment for that. Bridget, I don't know that I've answered that real well. I'm going to sum it up in hopefully a better way. Reserve studies on smaller projects can be challenging, but we will work through those. The reserve studies are not something in my world that I typically get hung up on, because I understand the intention and the purpose of that. It's kind of like your house inspection that you do with your buyer. You know, the plate's missing off the light switch, or, you know, there's a knob off of a drawer. It kind of ends up being that sometimes, and we just have to make sure that we're analyzing it, looking at it from the bigger picture and not just the individual transaction. Did that help, Bridget? There's a lot of variables in that question, so
Yeah, no, thank you. I appreciate it. I think you you were able to share some insight there that you actually look at it more closely than I think what and as far as reading the minutes and so forth, because we are definitely seeing, to your point, the smaller self-managed condo buildings in Ocean City. Some of those homeowners are saying, no, we're not going to adhere to the reserve study. So then, there just becomes the question is, is it, are you able to get financing if they're not adhering to the reserve study and bringing their reserves in line to what they need to be. So.
I've not, it's a double negative. I've never had an issue closing a loan where my reserve study was not in line with my reserve collection. As long as I'm meeting my 10%, I've not had one issue in closing and delivering a loan, knock on wood. Think we got, do we have any other questions or? Let's see here. I think we are good there.
I think you hit them all, Rick.
Okay, well, I'm going to jump back to the questions that were presented. The one with the biggest hurdle, it was broken into two, buyer specific and then property specific. The property specific one is a great question. I will tell you what I am seeing, and this is interesting, and it's a trend that's been happening the last couple of years. We typically don't question an appraisal from the standpoint of the data that's being given to us. The appraisers inspected the property. They're going to know more about the property than we do. But one of the things that has changed and continuing to happen is we will get an as-is appraisal, but then there's a huge hole in the ceiling in the living room. Most people will react to that from a sales perspective. Well, it's as is. Yeah, but there's a hole in the ceiling in the living room, and that's a health and safety issue. So this is one of the obstacles we're coming across in the underwriting world in relation to property. We are starting to see many more appraisals come in that are as is, but yet there are siding issues, broken windows. This is generally around a conventional loan. FHA, they're going to pick this stuff up. VA, they're going to pick this stuff up. And it kind of puts us as a lender in the middle of a situation that's not fun, because the appraiser says it's as is. We know the buyer is willing to move forward. They saw the hole in the ceiling and they just want to close. And they're going to repair it after the fact. The challenge we have with that is, regardless of the as is value, if there are any health or safety related issues, they have to be cured. Because when we deliver the loan, even though we know the appraisal is as is, those health and safety issues are going to pop up. How are appraisers doing this? They're doing it a wonderful way where they don't say anything at all in the appraisal. It says as is, and then you got a huge photo or a really nice clear photo with a label underneath it, living room ceiling hole. Most would think that we don't have to address that, but this is where this property specific issue comes into play. We will have to address it. So from a agent buyer perspective, one of the things you're going to want to be paying attention to, in my opinion, is just, are there any things like that? Knowing the appraisal is going to be done, even if the appraiser doesn't address it other than a photo, it is going to be a requirement that it gets addressed. Now, do I require that the appraiser go back out and make the appraisal subject to? No. Why? Because that's the appraiser's opinion, and I can't change his opinion. Now, what I can do internally is ask for those repairs to be completed. Might be an inspection by a contractor. Depending on the severity of the issue, we might do an escrow holdback. Something that I know lenders aren't comfortable doing are escrow holdbacks. Well, we're in an environment where there's not a lot of inventory, and if you don't close on the loan, the seller's going to go to the next one who will. So if there are no health or safety related issues, we'll do escrow holdbacks. I did one the other day for 15 days. It was a conventional loan. The electricity wasn't on because it was a bank-owned property. The bank's not going to turn the electricity back on. So do I not close because the electricity is not on? Well, it's kind of a catch-22 because I need to close to turn it on, but I can't turn it on without closing. So we did an escrow holdback, and how we overcame that situation is we had it inspected by an electrician beforehand. The power was not turned back on, so they of course brought the tools they needed, They told us that there wasn't going to be any issues. And we just do a small holdback so we can close the loan, have a little bit of money there if something was to come up or be delayed. The expectation would be close on Monday, powers on Tuesday, and we know by Thursday, Friday. We do that often. Property specific, continuing on that, starting to see a lot of this, C4s, condition 4. What that means generally is the home has never been updated. So we're starting to see a lot of homes that, you know, are clean, you can move in, but it's still 1977. 1977 kitchen, the window trim and all of that still is all 1977. That is not an issue. A house being dated that's livable as a C4 is never an issue. Where it becomes an issue with a C4 goes back to where I was speaking a little bit earlier is, are there health and safety issues? Because sometimes with a C4 there are, and generally I see one of them that came up recently is it was a C4 because of not being updated, but they noted a health and safety issue, and that was related to the toilet. And all that needed to be done was the toilet needed to be secured. It wasn't secured. So the health issue there is it's a toilet, it's not secured, could make issues. So we got that cured. Now that was an easy C4 to cure. A C4 where there's mold, that's a little bit different of a story on a C4 and is going to require that we have go in and get that cured. One last thing around the property, C5s. I don't know that you would ever see this on your end because it's the way we know in underwriting is never eligible. A C5 means the house is not habitable, would more than likely take a lot to repair to make it habitable. Have I closed a C5? No. Have I taken a C5 to a C4 and closed it? Yes. So just because it's a C5 doesn't mean it's a done deal and we can't close. We just have to make the appropriate repairs to get it to a C4. Did I miss any other? I don't think I did. Let me know if I did miss any other questions. Oh, I saw something here. What does a lender think of if there's water damage but has been cured and repaired if there's an issue for the lender? Oh, good question. This one comes up a lot, actually. Older homes, dampness in the basement is kind of common. If it is water damage that has been repaired and we have evidence that it's been repaired by a contractor, we're good to go. One recently, it was new construction. There was pooling water in the basement. I'm assuming maybe a really rainy day. I know some areas are getting a lot of rain. We had the builder, because it was new construction, let us know what the issue was. They resolved it. They had to do some grading. To answer that, Thomas, water damage isn't something that concerns me as long as it's been resolved. If you're dealing with an FHA loan, you kind of get in that weird, if they call it mold, do you have to go into the whole mold remediation? It depends. I'm just going to be real because we know happens. I bought a house where there was a little black mold under the basement and the little crawl space. We know what we do. You go in, you bleach it, you paint it, you put the kills on it, and you move on. If it's something minor like that, I don't get into the whole mold remediation. But if it's significant where it's pretty clear that an entire wall or ceiling has mold, we'd be having a different conversation around there. But generally not a big issue unless it's significant. It's going to get fixed. Great question. Did I miss any others? Does not look like it. Just going to jump to the next question. Regarding property, does the underwriter make or contribute to making a call to the appraiser regarding repairs? Only after we get the report. And typically it's quick clarification. If we see something in the report that requires a repair, like I was speaking to earlier, I wouldn't address it with the appraiser. He's pointing it out with a photo, so I just need to address it separate from that. Generally, no. I would answer that question as generally no, we're not engaging with the appraiser in repairs, because they're either identified by him or we're going to identify them as we review the report. Had a great question about, can a person purchase with an open judgment? My my canned response to that is, if it does not affect my lien position, yes. There are a few states out there, Iowa is one of them, where you could have a judgment, and if you're purchasing a home, your purchase money first will always be in first lien. Even if you owe Capital One 25 grand. In Iowa, you will always be in first lien when it is a purchase money. That's how they define it. So if it's not going to cause an issue with my lien position, generally not. If I'm looking at the different, if it is going to cause a lien issue, conventionally has to be paid off. They do not allow that to go into repayment. If there is a filed lien that pulls up on title and affects our lien as a lender, it will have to be paid off. FHA, they allow 3 months. So if you've gone into repayment on the judgment and you've made 3 months worth of payments, you've established repayment, that isn't going to be an issue. Now the question becomes is, are they going to subordinate any lien out there? If there's no lien and it's just a judgment, the 3 months is going to cure that. For VA, they're more restrictive than FHA, but not as restrictive as conventional. They're looking for 6 months worth of repayment. So if it's not clouding my title where it's going to affect my lien position, I am good to go. FHA and VA, as long as it's in repayment and I have those set payments made. And when I say 3 months payments, you can't prepay those. You have to pay them within the month due. So if I was to set up a judgment repayment today and my first payment was due May 15th, I'd have to make May, then I'd have to make June, and then I'd have to make July. Now, could I pay May now and June towards the end of May and July's towards the end of June? Yeah, but you could not pay all of them now, or pay one today, one tomorrow, and one next week and call those 3 payments made. Got a question that popped up here. How often during the transaction should agents be checking back with lender for status updates? That is a great question. In my world, everything operates in a 2 to 3 day kind of time frame. And I want to clarify what that means is, if a new file comes into underwriting today, it has to be out by end of day Friday. So that's where today would be day 1, tomorrow is day 2, and then day 3. Where we're at currently with turn times is the 24 to 48 hours on initial underwrites and resubs. So to answer that question for you, kind of hard, because I don't know how often you actually communicate with your loan officers. But if I was checking in, it would be typically midweek. I would want to know, I don't know how things are communicated, and I apologize. I know we have a lot of automation that goes out. But if you do receive a notification that the file was submitted to underwriting within 2 days, 3 days, it would be acceptable to follow up, because you should expect that there was a decision made by that time, or have some kind of update on additional information needed from the borrower. Does that help? I think, is it Thomasina? Did I pronounce that correctly?
Yes, thank you. That did
Yes.
help. I I sometimes wonder, like, am I calling too much or am I calling enough to check on the status of things just to make sure everything is, moving successfully towards close. So, and then sometimes I'm not sure if, like, I'm stepping on it, just say if I'm the buyer's agent, am I stepping on the toes of the seller's agent by, calling the lender and say, hey, what's going on? Or if I'm the seller's agent, if I'm the listing agent, reaching out to the lender to say, hey, what's going on? Where are we? So I always, try to be mindful about not stepping on toes, but staying on top of where we are in the transaction.
If you know where your stage of your file is as far as the what we call milestones, approval, resubmittal, clear to close, if you're familiar with when those dates happen, a follow-up within a couple of days isn't, in my opinion, excessive, but I'm not on that side, so I wouldn't want to set that stage for others, but it would seem logical that you would be checking every 2 to 3 days, knowing where the milestone is, because something that people may not realize is, your loan gets approved, we communicate that, and then there's a lot of time where we're just sitting and waiting, which leads me to the next question that came up, and is what are some common mistakes that people often make? In the mortgage world, in the lending world, going through the process of application to clear to close, two things: responsiveness and communication. That generally is between, it's generally the borrower. I think that is one of the challenges we have in our environment today. Um, it's a complex process, and I think some people just want to turn a blind eye to it and just avoid conversations as far as following up and figuring out where documentation is. That is honestly the responsiveness, one of the biggest challenges we have. I hear it often from um, the sales partners that I have, where I've been trying to get this borrower to give this to me for 3 days. Is there anything else we can do? That is a very common conversation that happens. And I think that happens simply because, again, going back to borrowers want to turn a blind eye. It feels really overwhelming. Um, they don't realize the significance of turning something in. Like if we're asking for an updated bank statement, we know you're not closing until June 1st, but getting it sooner than later just moves the file quicker through the process. I have not originated in years, but something I used to do when I originated is when I had those challenging times with a borrower, I called the borrower's agent and just said, you know, Anna isn't sending me her most recent bank statement and I need it because I can get it in and clear it to close now, 10 days before closing. Could you help me out? What I find in those situations, buyers tend to move a little bit quicker when their agent's calling them because it feels a little bit more important. I don't know why that happens, but it does. I often say that to my sales partners. Hey, did you call the agent and see if you could get that if there isn't an alternative as far as documentation goes? Um, the other challenge that I find common is just the communication in itself. And I think that comes from people not really understanding what happens in our world. I think, we expect consumers, borrowers, sellers to know what happens behind the scenes as an agent, working on buying or selling. They just have this perception that there's not a lot that goes on, but there is. Same thing with the mortgage process. We do everything we can in our world to make it simple and seamless, but if we're not communicating well, it becomes a big part of the hurdles in getting things done. And things that I think about with communication, going kind of back to the buyer specific hurdles. I'm a buyer, and I come along, I'm like, I work 40 hours a week. Well, what you didn't tell me in that 40 hours a week is that's kind of on average. But if you take a day off, you don't get paid. And I can't give you money for a day you don't get paid. Therefore, if you're not always working 40 hours a week, either working or working and getting PTO pay, you're not a 40-hour work week borrower. Now, does that mean I have to jump into doing variable income? Not necessarily. But if you tell me that you are making $25 an hour and 40 hours a week, and I do the math and I'm qualifying you off of that, and then now I found out, well, it's really not always, it's maybe 3 months out of the 9, that's going to skew it. And then all of a sudden, am I looking at a borrower who really only works primarily 32 hours a week, which is then 8 hours? And that could be a lot of income when you're pushing those ratios. So communication is really key, along with that responsiveness to help keep files moving along. Got quite a few more, so I'm just going to keep going. Unless people have questions, please just raise your hand. Another question that came up is, how can agents assist clients in avoiding the most common mistakes? I say this often, and I think people get really tired of me hearing it. I believe in the 2-2-2-2 rule. I want 2 pay stubs for 30 days. I want 2 years of W-2s. I want 2 months of bank statements, and I want 2 years of tax returns. From an application standpoint, you give me all of that. 9 times out of 10, probably 9.75 out of 10. The only things I'm ever going to ask for is letter of explanation for inquiry, letter of explanation for addresses. Maybe I have to tidy up a couple of little things. But if I've got 30 days worth of pay stubs, 2 years worth of W-2s, 2 years worth of tax returns, and 2 months of bank statements, I've got a fully documented file. Now, when I talk about tax returns, if your borrower is self-employed, that's 2 years personal and any business related. If we can engage with that up front, a couple of things happen, in my opinion. One, it reduces a lot of stress off your borrower from this, and you, from the standpoint of, we're not going to nickel and dime you. What I find happen a lot is, oh, you gave me a pay stub in last year's W-2 and I told you we were good. But now as I'm going through the file, it's like, oh, now I got to ask for this. And now I'm going to ask for this. And then I get over to that hurdle and now I'm asking for this. And something I know we've done well in this business is caused this anxiety around getting a mortgage loan that is really driven by us constantly asking for documents. And that's why I really believe in the 2-2-2-2 rule, because I'm not going to ask. And I always put myself in a consumer's spot, like a buyer. Buying a house is stressful. I'm stressing about 2 things. Am I going to get the loan? And am I going to get the house? And they're independent and collective, because I'm worrying about them separately, but at the end of the day, I'm worrying about the whole thing. And if we can do a better job on the lending side and not create that anxiety by being up front with what we need, it's going to eliminate that down the road. And why I say it the way I'm saying it is, I gave you my documentation today on 5/1, and you said I was good. 3 weeks go by, I haven't heard anything, and now you're calling me for updated documents and I'm closing in 10 days. I'm freaking out. I thought I was good. And although it's easy to get the documentation, it creates that panic, and it's one that we could really avoid. So to answer that question with how agents can help us move files along, be advocates for full documentation up front as you're working with your borrower, and just getting them out looking at houses. Hey, do you have your 2-2-2-2? And then from a file process standpoint, having that open communication with your loan officer as well, and saying, hey, we're 12 days from closing. What are you missing? Have you asked the borrower? Oh, you haven't? Okay, well, I'm going to call them as a courtesy and just check in and just go, hey, Anna sent you an email and there were 3 things on that email. And I know it just came over yesterday, but we're closing in 12 days. Could you commit to getting that to them by the end of today? helping set that expectation. Because again, think of it from a buyer standpoint. They don't know what's going on. They're just thinking everything's happening. And so when things get delayed and then we're following up at the last minute, that's where that anxiety gets created. Had a question about the perfect or simple file. Wow. Do those even exist anymore? I don't know that they do. If I was to give an answer to that, I mean, a simple file is a really large down payment and lovely reserves and, making a ton of money to keep my ratios down, but I don't see that very often. So to give an idea of a perfect simple file, I don't know that I would be fully honest in that because I don't know that they exist anymore. But again, going back to the 2222, that makes it a simple file. That makes it a simple file because I have everything right there. Do we have any other questions? No. Had a question about if we should get comps and offer them up to the appraiser. We cannot do that. We can do that when value doesn't come in and we're rebutting it. But if we were to provide information up front, it would be perceived as we're helping guide value. And after the housing crisis of 2008, 9, 10, that was a big piece of that. Like even I, as an underwriter in my role, cannot talk to an appraiser about value. I cannot. Now I can email and ask why certain comps were used, leading to why I'm questioning value, but I can never just question value. So with the comp thing, we can only provide those once the appraiser's done the work and returned the report. Otherwise, we would be influencing value potentially. Great question, though, because I know that comes up often. Had a question about what documents are required for an out of country seller when selling their home under an assumption. Great question. Hard for me to answer for one reason only. We're not a big servicer, so assumptions are handled by the servicer. So whoever the lender is who has the loan, they're going to be the ones that are going to address that. Having had experience in assumptions, it's a similar closing to a typical purchase because you have a buyer and a seller. You're doing an assumption mortgage versus a new mortgage. But when it comes to closing disclosures and exchanging of money, all of that is done the same. So it's done through a title company. So if you have an out of state, it'd be like an out of state seller or out of country seller. We would follow the same process. We'd talked about blanket insurance with high deductibles. I want to make sure that I covered that. Had a really great questions around how do you know that you have a valid pre-approval? I love that question because I am a huge advocate in doing what we call loan commitments. And doesn't matter where your borrower or buyer is in the stage, I love loan commitments because what a loan commitment is, and then I'm going to go back to the pre-approval question, is a full underwrite by an underwriter, meaning everything's been addressed. Everything. I know we may not be closing for a couple of months, but let's say one of the things we look at with assets is large deposits. Let's say I have a couple bank statements that have large deposits in them, and I need those funds to close. For us to do a loan commitment, we would validate what the source of those funds were. Whereas with a pre-approval, you would not. So pre-approvals, everyone handles a little bit differently. There are some who pull credit, run AUS based on information provided from the borrower without validating. So that's a borrower saying, I make $100,000 a year, I got 200 grand in the bank, I pull credit and I run off of those numbers. That's not a very solid pre-approval because I haven't validated anything in the file other than their 720 credit score. There are also others who go a little bit deeper and they actually go in and analyze the income. So the credit and the income has been analyzed, which honestly, income is the variable that is always the stumbling block. Assets come together, credit we already know about. But there are a lot of individuals that'll do a solid review of the income, including having our underwriting department look at the income and make sure that when they're issuing that pre-approval, not only is the credit solid, but the income is solid. And then you have some that do the loan commitment where it's gathering the 22222, turning an entire file, getting an entire underwrite, which then gives you a loan commitment, which from a lender standpoint, when you get a loan commitment, that isn't a pre-approval. It means I am going to give you $200,000. So go find the property. There's going to be no questions other than getting the contract, getting the flood, if the flood cert, the appraisal if required, unless you get a PIW. So I'm not sure that I'm clearly answering that question in my head, but if there are stages of pre-approvals. If I wanted to know the validity of a pre-approval before I took a buyer out to spend a Saturday, I'd want to ask the following. Did you actually analyze their income? Did you actually look at their bank statements? Because pulling credit based on stated information can easily get you an AUS approval. You just put in enough to make that happen. Oh, Tom asked about the 222. 2 pay stubs, which equals 30 days, 2 years W-2s, 2 years tax returns, and 2 months bank statements. I think I've gone to the end of the list of the questions. Let me just make sure, because as we were talking, some of these popped up.
Cynthia had a question, Rick, for you. Foundation issues, question mark.
Oh, I love that. Foundation issues. The tough one.
I
'Cause
love
there's
to
a lot
watch
of-
you think.
There's a
Love it.
lot, there's a lot of things that start running through my brain. Simple little crack on the outside of the foundation. I don't care. I really don't. That's settlement that's going to happen, especially when you get into older homes. That settlement's going to be even more so. I want to talk about foundations because this comes up a lot. Rock foundations, where they literally built it out of rocks, and that is the foundation. If I have no water intrusion, my appraiser doesn't make any comments related to that foundation. The house is 150 years old. Clearly, that was the foundation used at that time. Not an issue for me. Small little cracks, not an issue. Sagging on one side, like when I'm in the basement and I see it goes like this, that's definitely going to cause a lot of questions, possibly leading to a structural inspection to see what is causing that. Typically, those are older homes. So again, that's settling. I've had that happen often throughout my career. We get someone to go in and look at it, a foundation person, possibly an engineer, which I try to stay away from because it can be really expensive. If it's adequately addressed and isn't going to affect the structural integrity of my property, a foundation doing this adequately explained isn't going to be an issue unless there is significant separation from the floor joists and the beginning of the foundation. Did that help?
think there's one last one, Rick, from Regina, and then I think that's a wrap because I know you've been going for a long time. Can down payment assistance programs be used on a 4-unit owner-occupied building, similar to a single-family resident?
Ooh, good question. I would have to defer to individual down payment assistance programs, but generally a 1 to 4 owner occupied is not an issue for DPAs. If there is, they're going to note that. What's going to drive that, of course, is the occupancy piece of it.
Awesome. Thank you so much, Rick. I really appreciate you sharing your knowledge with all of us
Yeah,
today.
I hope this was helpful. I'm glad people joined. I don't mind doing it again if there's ever an opportunity.
All right. Love it. Love it. Love it. Thanks everybody for joining. Have an awesome Wednesday.
Thank you.
Thank you.
Woohoo.
Thanks, Rick.
Have a good day, everyone.